In the world of investing, there has always been a debate between real estate and stocks regarding which one is the better investment. Think of it like Batman versus Superman, but without the explosions or the spandex. Over the past 50 years, real estate and stocks have been popular choices for investors that want to secure their financial future. But how do they compare, and which one should you pick? Or dare I say it, can you do both? Stay tuned, because we're about to break down in this old age debate real estate versus stocks and which one is the better investment. My name is Steven Smith, and I'm a finance nerd here at NerdWallet. Before we start, I want to remind everyone that I am not a financial advisor, and this is not personalized financial advice. Between 1992 and 2024, the S&P 500 index posted an average yearly return of 10.39%, including dividends. When accounting for inflation, this translates to a 7.66% return. Meanwhile, the US housing market experienced a growth rate of approximately 5.5% during the same time frame. So to address the elephant in the room, yes, stocks have outperformed real estate over the past several decades. However, over different time frames, the relative performance may look very different. The Case-Shiller Index, which monitors residential property prices, has shown much less fluctuation, generally increasing at a steady pace. This trend highlights the consistent demand for housing in key markets due to limited supply. This makes it a much more stable investment compared to stocks. The key difference between investing in real estate and investing in stocks is that real estate involves buying and selling properties, while investing in stocks involves buying and selling a share of a company. Have you ever heard the saying, "Don't wait to buy real estate and wait"? Real estate's often seen as the safe bet, the slow and steady moneymaker. But what's really attractive about real estate is that you can earn income while it's growing in value. That's right, passive income. Whether it's through rent, short-term rentals, or flipping houses, real estate can give you steady cash flow while the property value increases. For example, if you buy a property and you rent it out, you'll get paid monthly. Real estate also has tax advantages which can really help you keep more of your gains. Things like mortgage interest deductions and property depreciation can make owning real estate a very tax-friendly investment, especially when you compare it to stocks. You'll also have the advantage of investing in real estate with borrowed money. By applying for a conventional loan, you can invest in a new property with a 20% down payment or less and finance the rest of the property's costs. You can also invest in stocks with debt. This is known as margin trading, but it's extremely risky and only for experienced traders. So in comparison to stocks, real estate is a lot safer if you intend on leveraging debt. Most borrowers are eligible for a mortgage with a down payment of at least 3%, although the amount may vary depending on factors like your credit score and debt to income ratio. You'll also need to meet the minimum credit requirements for the loan, although other criteria may vary from lender to lender. Let's not forget the giant chunk of your paycheck that gets swallowed up by maintenance fees, HOA, landscaping, and appliances, to name a few. These expenses can add up over time, especially in the early years of your mortgage when interest payments are substantially higher. Owning property requires much more sweat equity than purchasing stock. While property prices tend to rise over time, there's always a risk of selling property at a loss. The 2008 financial crisis and post-pandemic uncertainty in the housing markets are reminders of that. This is also true of stocks, of course. Now let's talk about stocks. Unlike real estate, stocks are incredibly liquid. If you need cash, then you can sell your shares almost instantly. No waiting for buyers, no lengthy negotiations, and with the explosion of apps like Robinhood and Webull, trading stocks has never been easier. And let's face it, very few people have the time, let alone the cash, to purchase enough real estate property to feel truly diversified. Stocks require very little to invest. In fact, with fractional shares, you can own a piece of Amazon, Tesla, or even Apple with just a few dollars. You'll need to open a brokerage account to buy and sell stocks, and you can use apps like Robinhood, E-Trade, and Vanguard to track and manage your investments right from your phone. These apps offer a variety of benefits, including commission-free trading, access to educational resources like videos on investing basics and market trends. They also offer enhanced risk management strategies, all packed in one intuitive user interface. It's like having a personal assistant who knows exactly what to do with your money. The major drawback of stocks, of course, is that they're volatile. They go up, they go down, sometimes very wildly, and if you panic during a market crash, you're more than likely to sell low and miss out on the recovery. And while the S&P 500 has historically delivered 10% annual returns, it's not guaranteed. The market can take a turn, and that part of the risk is like playing poker with your savings. You have to know when to hold them and when to fold them. Emotional control is key in the stock market. If you can't handle seeing the ups and downs and you can't resist checking your portfolio every 5 minutes, you might want to stick to an investment that's a bit more relaxing. But if you're in it for the long haul, stock investing can definitely make you a lot of money. Whenever we talk about making money, we also have to discuss a chunk of that going to the government. Whether it's your gains in the stock market or real estate profits, Uncle Sam has to have his cut. When you sell stocks for a profit, you're hit with something called capital gains tax. If you buy and sell your stocks in the same 12-month period, you're stuck with short-term capital gains, which is taxed at regular income tax rates. Yes, those rates like 24, 35%, or even as high as 37% depending on how much money you make. So a quick flip can be more like a quick tax bite. If you've held your stocks for more than a year, congratulations, you're a long-term investor, and this also means you're getting long-term capital gains tax rates, which can be a little kinder to your wallet. At the moment, long-term capital gains tax can be 0%, 15%, or even 20% depending on how much money you've made. So if you're lucky enough to be in that lower tax bracket, you might just pay 0. But if you're raking in the big bucks, you might be paying 20%. Now looking back at real estate, let's say you purchased a cozy little house of $200,000 back in 2021, and now it's worth $500,000. Sounds like a dream, right? But hold on, before you start dreaming of buying a yacht, here comes the tax man again. When you sell a property, you're going to face capital gains tax once again, but the rules are a little bit different here. If you've lived in the house for at least 2 out of the last 5 years, you can exclude up to $250,000 of gains for an individual or $500,000 if you're filing jointly. Ultimately, real estate and stocks both have their ups and downs, but they can both be powerful ways to build wealth. So which one should you choose? Well, if you like to deal with tangible assets, then go for real estate. If you like to deal with charts and prefer liquidity, then go with stocks. And if you're like me and you can't decide, then why not try both? After all, there's always room for a diversified portfolio. Investing in real estate investment trusts or REITs can give you a combination of both real estate and stock investing. REITs are companies that own, operate, or finance income-producing real estate across a wide range of property sectors. These investments allow you to earn income from real estate without having to buy, manage, or finance properties yourself. I'll drop a link for more information about REITs down in the description. Ultimately, both real estate and stocks are excellent vehicles for building wealth. The best one for you depends on your personal goals, your risk tolerance, and time commitment. And remember, mixing real estate stability with stock investment growth potential for a diversified investment strategy is still a great option. If you found this video helpful, make sure to hit the like button and please subscribe for more investment tips. And of course, drop a comment below. Which do you think is better? Real estate, stocks, or was it both? Let me know. I love to hear your thoughts, and thank you so much for watching.